Well, welcome to Dairy Livestream. I'm your host, Corey Geiger, managing editor of Hoard's Dairyman. We are broadcasting from our cheese cave here in our downtown studio in Fort Atkinson, Wisconsin, at the historic W.D. Hoard & Sons Company building commissioned by Wisconsin Governor W.D. Hoard. It's literally pretty chilly in the cave here, so I'm going to keep my coat on. We have three great panelists today, and they look forward to answering your questions. You may ask a question by submitting the question into the GoToWebinar question panel. I'd like to remind our audience that to ask questions early to ensure we have time to answer them as we move through our webcast, how we're evaluating farm loans these days. We're almost a year into the COVID-19 pandemic, and businesses have faced a tumultuous journey due to the health situation. Dairy hasn't been immune, and nor has one of the largest group of customers for dairy products, restaurants and food service. Because these important customers continue to struggle, the situation will impact dairy product sales, and it behooves all of us that are running dairy farms to sharpen our economic pencils, because there will be an impact on milk prices, and we don't have federal transfer payments to dairy farmers due to programs such as the CFAP, Coronavirus Food Assistance Program, and Farmers to Families Food Box programs that are going to be slowly sunset here. Just how deep has been the impact to restaurants and other food establishments that soak up about half of all U.S. dairy products? Let's go to a poll question to get some depth in here. Restaurant sales for 2020 were projected to be $899 billion. Round number 900 billion. How much did they fall this past year? Pick one of the following: 40 billion, 240 billion, 440 billion, or 640 billion. So go ahead and answer that poll question. We have one response that is really gaining a lot of traction. And let's go ahead and cut that poll off. And indeed, 56% of you got it right. The answer, actually, that's incorrect. 22% of you have got it right. 240 billion. So about 1/4 of the sales have been sunset. There are some restaurants that are doing really brisk business in carry-out and have mastered that. But this also tells us that milk prices could be in for a roller coaster as U.S. eating pattern and establishments really try to move through the pandemic and get back on board. Our first Dairy Livestream panelists will shed some light on how you can review your farm finances given this sales situation. Let's first welcome Sam Miller of BMO Harris. Sam was on our May 20th episode of Dairy Livestream and has been in the banking business for over 3 decades. After originally starting with M&I Bank, Sam now leads all agricultural banking at BMO Harris. An articulate thought leader, Sam is also a faculty instructor for the National School of Experienced Ag Lenders. Sam, when you talk about farm loans and farm finances, what are you sharing with your dairy farm clients during this continued pandemic?
Well, thanks a lot, Corey. Great to participate again in Hoard's Dairy Livestream. I'll get to your question in a second, but I want to take a step back and let's look at what's happened in the past 13 and a half months. I mean, it reminds me a little bit of the Billy Joel song, "We Didn't Start the Fire." But this happened in the last 13 and a half months. We've had many ups and downs, and it's been a wild ride. We had new trade deals that have improved ag export opportunities with China Phase 1 and the USMCA agreement. We had 2 impeachment trials for the same guy in the last 13 months. A global pandemic. Milk prices crash, and then 2 months later are at record highs. I've never seen that in my career. An alphabet of government aid, PPP, EIDL, CFAP 1 and 2, and the old standby CCC. Sports and everything else goes on pause for a while, and then when it comes back, nobody's in the stands. Grain and oil seeds rocket higher. We had social issues ramp up across America in the last year. We had a contentious election. Now there's a new administration, and there's different priorities and policies. And the good news, vaccines are finally rolling out, and so there's some cautious optimism. So with that as a backdrop, you know, the webinar today is titled, "How are we evaluating farm loans these days?" And the answer is the same way that we always have. We're looking at what are the core strengths. What does the balance sheet look like? How about profitability, cash flow, both your cash flow from this last year and what does it look like next year going forward? Liquidity, price risk management, and the forecast. In short, we're in a much better position than we were a year ago. Even though we had the wild ride with milk prices actually were pretty good. It really depended where you were, who your processor was in terms of some of that pay price, but nonetheless, between the core base of milk prices and the alphabet soup of government aid that came farmers' ways, it was the best year in 6 years. Liquidity is better, equity is better, cash flow was good, and a lot of price risk management tools have been employed and continue to be employed. So I'm sure we'll get into some more details as the webinar continues, but that's a real quick overview, I think, about where we are and what we're starting to look at as we roll into 2021.
Thank you, Sam. As a reminder to the audience, as you hear them speak and you have questions that come top of mind, go ahead and type those into the GoToWebinar control panel. Also, each Dairy Livestream webcast is archived the very next day on our Hordes Dairyman website and our YouTube channel. If you just go to www.hordes.com, you'll find it under our webcasts system. It's really simple to find. Net earnings on dairy farms have varied greatly, even before COVID-19 entered our lexicon last year. The following poll question is based on data from the Northeast Dairy Farm Summary as published by Farm Credit East. Let's go ahead and put that poll question on here. In 2019, what range was net earnings per cow for the top 25% and the bottom 25%? So the bottom number is minus 245 per cow and plus 356. Minus 204 or plus 629, minus 447 and plus 272, minus 359 or plus 965. So go ahead and answer that poll question here. And it's going to be a foundation for our next conversation with Roger Murray, who's joining us also today. So we'll go ahead and cut the poll off here, but we're going to put the answers up. And we're going to ask that our producer here keep them up on the screen for a little bit because they're really important. For starters, we're delighted to have Roger back with us too, who joined us last in May when we were really swimming hard during the pandemic. Roger is Executive Vice President at Farm Credit East and co-author of the Hordes Dairyman Money Matters column. Roger, we're going to talk through that poll question. And as it turns out, the answers are all correct. It just depends on the year. So the top one there, the minus 245 for the bottom 25% and the plus 356 profit per cow was the answer for 2016. The 204 minus to the plus 629 range is the answer for 2017. The minus 447 to plus 272 is the answer for 2018. And the correct answer to this poll question is minus 359 for the bottom 25% of dairy farms in that data set. And plus 965 per cow for the top group. And again, this is 2019. Roger, that's a $1,342 range from the bottom 25% to the top 20% in 2019, and that surely impacts how you evaluate loan potential. Roger, please tell us more.
Well, thanks, and again, thanks for inviting me on the show. Glad to be part of the crew with Chris and Sam as well as you, Corey. I think a little bit about myself. I grew up on a dairy farm in upstate New York and have the third and fourth generation of our family still involved in that. So I am connected to what goes on. And obviously, as our 7-state area here in the Northeast, we lend a lot of to dairy farmers. It's our number one commodity. What Sam mentioned was exactly what we talked about last year and exactly what I would echo again. When we're looking at variability of the earnings that you just saw from the bottom 25 to the top 25%, it really shows those businesses that have the resiliency to make adjustments through the years. And those that do have a better chance. They're maintaining their flexibility. They're adapting to change. They got the strong liquidity and strong net worth that were talked about. They're investing in some education to try and stay up with all the new nuances that are going on, whether it's the acronym soup of government support programs and or dairy risk management strategies. We really look at those strongly and making sure customers understand what's going on to their particular farm. When we were talking about it yesterday, Sam talked about how individual this whole analysis has to be, and it's so true. The budget on one farm can be totally different than another in one region of this state to another. So we look a lot at the individual ability of that farmer to be able to know its milk market is probably one of the biggest things we've seen a change from last year, or a further emphasis as cooperatives come out with base excess programs. Some don't. All of those things would need customers to be able to understand what their cost of production is and make adjustments to their business to do that. We've seen them, should they revert to a 2x milking when they were at 3x? Should they adjust their production and rations so that they can afford not to be penalized by a different excess price? And I think those are options that everybody has to look at. Anybody on the call already knows. We're not dealing with a factory. We're dealing with biological animals, and any adjustments or changes we do have lasting effects, certainly at least through the lactation curve. So there's just a lot of options to consider, and rather than go into more detail, I'm just excited about our opportunity to listen to questions, and we'll try and respond as best we can. So Corey, back to you, and Chris and Sam.
Thank you, Roger. And it was interesting. One of the things you talked about was the impact and dairy has on your portfolio. To tease a little bit of an upcoming editorial comment here that's going to be probably in our March edition, dairy is a big part of agriculture. And the following states, it's the number one commodity: California, Idaho, Michigan, New Mexico, and New York State. 53.5% of all egg sales are dairy. Pennsylvania, Vermont, and Wisconsin. In Wisconsin, it's 50.7%. And then there's another tier of about a dozen states where dairy ranks second or third. So if you're a loan officer, dairy is a major consideration in what you're doing. And I think our audience needs to remember that you're a big deal. You're a big deal in the world of agriculture. So with that, we're going to go to our final poll question here. And again, when you have questions, we have a nice group of questions coming in here and some very thoughtful questions. Our final poll question is: strong feed prices remain on the horizon. Which of the following is true? Corn posted prices not seen since 2013. Soybeans are trading at 6 years high. All the above or none of the above? So go ahead and answer that question. And Chris, it looks like if these were students at Cornell, you'd be handing a lot of A's out here. We're at just about half of the poll taken, and we're at 90+% accurate answer here. So we're going to go ahead and cut this one off quick here because everybody's got this one right, just about all of the above. And this is as of the first year. The trade demand for corn and soybeans is brisk. Wheat is almost equally in that category here, especially with a lot of concern about the cold weather we've been having, although the U.S. is a lot bigger player in corn and wheat. Chris, welcome back to Dairy Livestream. What counsel can you offer to dairy farmers given the current price forecast? How might those conditions that are taking place right now impact dairy farmers, and what conversations might they be or should they be having with their bankers?
Thanks. I'm glad to be here on this cold winter day here in Ithaca, New York, but at least it's clear, which we haven't seen a lot of sun in the last couple months. We're starting to get some idea of what the dairy farm financials look like for 2020. They're starting to come in, get some idea of how farms did, and there's a pretty wide range of performance, as Roger and Corey, you talked about. Maybe even wider than what we'd seen in recent years. I guess we have to kind of wait to see, but there seems to be three factors that are kind of driving what kind of year the farms had that have got their financials in. Where the milk is marketed, what kind and how much government payments they received in 2020, and then what was their use of risk management programs and kind of how did that work out for them, particularly risk management programs that they had in place, obviously entering 2020 before the pandemic hit, because lots of crazy things happened with the roller coaster after we got into the pandemic months. And with respect to where the milk is marketed, right, it's a lot about the supply chain, the contracts, the products, the outlets that where your milk is ultimately ending up at, right? We've had really uneven effects of this pandemic on different industries, and it really shows up in food away from home versus food at home. So if your milk was ending up largely in school lunches or in sit-down restaurant type products, then that got dramatically affected. If not, then maybe your co-op or wherever you're sending it ended up with a much better pay price, and the result is a real wide range in farm milk pay prices, and that's going to continue to be an issue as we're still not out of the woods in this pandemic, I think. And looking at the supply situation that we currently have, there's some reason to think that these co-op based programs may be part of the discussion again. At least that's what I'm hearing in some locations, and that's going to impact things differently across different regions and different farms depending on where it's going. The second factor with the government payments, as Sam talked about, the alphabet soup of the different programs, but in particular with the coronavirus food assistance programs, the CFAP and the PPP loans and EIDL and things like that, that depended on whether a farm ran up against payment limits, because you could get payments obviously on the milk, but there were also other crops. And so, how the farm was legally organized and whether they could end up getting some of these payments across all their milk versus only a portion of it really kind of drove the level of government payments. And as you alluded to, we haven't seen government payments at that level in a long time. And we're unlikely to, it seems, if I had to predict right now, that we're unlikely to see that level of payments again. And it would be interesting to hear Sam and Roger talk about how they're kind of budgeting their approach to that when they're talking to clients. And then finally, the use of the risk management programs was really important for the farms, especially that had contracts entering 2020. We had that massive roller coaster ride in class 3 where we had, cheese prices below $1 and then up near $3 and then back down and back up again, depending on the government purchases and other through the food box program, which again is, we'll have to see what happens. There's still some unspent food box money from round 5, which was part of 2020, but the new administration looks like they may have a little bit different approach to food purchases. But then on the risk management side, it also depended for 2020 on how much you were, say, in class 3 markets versus class 4, because while class 3 was a roller coaster of up and down, class 4 was just sitting near the bottom and continues to do so as we balance these markets by producing a massive amount of butter in 2020. That's a lot of it is sitting in inventory at this time, and we're going to have to figure out how we're going to either eat our way out of that or get it exported so that we can, get those prices back in line. But it's going to be real interesting to hear what Sam and Roger's approach is here. Thanks.
Well, thank you, Chris. And as a reminder, we're going to go into our Q&A portion, and we have a lot of time here to do that, and which is always exciting. So again, there's a panel on your GoToWebinar control panel. Go ahead and ask a question. We're going to go back to that second poll question first. And we're going to start with Roger, but I know Sam has data sets in front of him. I know that Chris has worked a lot with that at Cornell and is previously at Michigan State University. The question comes like this. Do dairy farms in the top 25% and the bottom 25% tend to be the same farms year after year? Or is there some fluctuation in those groups? Roger, why don't we take that to you first?
Obviously, people can't be in the bottom 25% for very long, because sooner or later they'll have to choose to do something else, unfortunately. But I would say it does fluctuate, and a lot of it can do with local impact. So a herd health issue could be a problem in a hurry. Certainly, a very poor crop year could also be have a big major influence. And then there's other things on what they're doing with their milk market. We've seen a lot of changes in the marketplace, and some folks that were always able to guarantee to have their milk sold at a fair market clearing price now are having to deal with some adjustments. And so some of those that may be shipping to smaller independent markets also had some bigger volatility swings in what they got paid. And that can have an impact for some of the smaller operator and smaller co-ops. But getting back to understanding a little bit of what we're doing and evaluating loans, we really want to know what their costs are. And then, for instance, last year, one of the things we're looking at is what could they produce milk at, what would be their net cost of production when you don't factor in the government support payments. Last year, close to $2.50 a hundredweight, depending on the operation. And that's a sizable sum that we don't have a good feel for where it's going to turn out in 2021. So that's certainly an area that will sensitize a lot of customers' budgets with, is whether or not they're able to sustain future earnings with a much lower government subsidy.
Thank you, Roger. Let's turn to Chris next. Talk about that top and bottom quartile and what you've seen in the data over the years.
Yeah, thanks, Corey. Well, Roger makes a really good point, which is that if you're continually in the bottom quartile, the survivability issue comes up at some point, right? So recently we looked at was it 15, 16 years of data from Michigan State and Wisconsin, where we had at least 9 years of observation on these farms, and we were looking at that very question about quartiles, and it was about there was a lot of variation, especially bouncing up and down into the middle and back up or down. But about 40% of the time, if a farm was in the top quartile one year, that was the likelihood of them being in the top quartile the next year. But it changed if you looked at over a 2 or 3 year period, because there's a certain amount of management, but there's also, like Roger said, there's luck and other issues that come in, because if you have everybody has a herd health train wreck at some point, it seems like, right? And that really shows up on these type of data, or a weather event and things like that. I mean, we're going to have some issues coming out of the snowstorm that we've had in Texas and New Mexico, where those guys are going to be working through for a while. And that's going to have impacts, not just to them, but to the whole national market. But it's really difficult, because it's such a competitive industry with such good managers to kind of stay consistently in the top. But that's obviously what you aim for.
Sam, anything to add in that realm there?
Yeah, I've got a couple of thoughts. I mean, Roger and Chris did a great job of outlining it, and we've seen the same thing. I mean, generally, you tend to stay in your band, but you can fluctuate between them. What we've looked at is, what is the difference between the top 25 and the bottom 25%, or where you are, and frankly, it's only in a couple of areas. It's in heifer raising costs, it's in feed expense, and to some degree equipment investment, and in the capital structure. So In other words, if you built your facility a while ago, it is a cheaper cost structure for you than somebody who built it more recently when you've got higher steel and lumber costs. If you've got a lot more debt, that means there's more burden for that business to carry. So those are the things that really make a difference. So the early adopters of using sex cement and cutting down the number of heifers that they have, because that heifer has not paid for herself for a while. And so just having the number of replacements that you need with a little bit of surplus rather than a whole lot of surplus, that's been one of the big separations that we've seen in those quartiles.
Thank you, Sam. We're going to take this question straight back to you, but to start with, and everybody has talked about this early on in our dairy live stream, but we talked about how loans are still being evaluated by the same standard criteria. But given our experiences in 2020 and early 2021, do you recognize any bigger risks on dairy loans?
Sure. Yeah, that's a really great point. And again, the lending standards and practices really don't change. The quality of the financial information, the financial statements, the financial performance does change. So how you look at it and how you evaluate it makes some changes. So to put a fine point on answering your question, the volatility that we experienced last year and the uncertainty it's off the chart. And so you've got to really be looking at what are the scenario plans, what are the sensitivity analysis in evaluating the forecast and what people are planning to do. You know, using a 5 or 10 year average on milk price, that just doesn't cut it. That may be your starting point. Then you've got to figure out, okay, what can go wrong? And guess what? Things can go wrong to the bad, and we're going to concentrate on that. But they can also go wrong to the good. And then what do? How do you, where do you invest if you have an excess cash situation? And that can happen throughout the period of the year. So those are the big things. And price risk management plans, we have more tools today than we've ever had. And so how are you going to use them? How are you going to have them linked together and complement each other instead of compete? Those are a couple of thoughts I have on that front.
Roger, any more significant risks in this time horizon right now for dairy?
I think Sam nailed it. To me, the biggest additions to that is the speed at which things change and the speed at which our managers have to adjust has gone off the charts. If you can no longer wait till year end to pull the numbers and see how you did. You got to know every month what you're doing, adjust that milk, the feed costs, adjust to the market conditions. Certainly, we talked a little bit about, Sam did, about dairy markets and risk management, knowing when to lock in 5% of next year's production and when to lock in 25% of next year's production as far as a price floor is huge. But I think the speed at which that is changing and the adjustments needed are critical. And that comes to how folks are building their support teams of outside advisors and investors, whether it's the vet, the nutritionist, certainly their lender, and others to help through this really makes a difference. And we've seen those that share that perspective with others within their group really build a better team to help manage that farm operation. It's not typically one person either. Everybody's got to be in alignment.
Chris, you've been with us since we launched DairyLivestream. What have you gleaned from the new risk standpoint?
Well, a couple of weeks ago, we spent time talking about human resource risk, and I think that's a big deal in the current climate, right? But we kind of spent a whole live stream on that. I think the other thing that I would say is is kind of be aware of your own cognitive biases when you're looking at these risks. There's a tendency just for all of us to kind of overreact to really small risks and kind of ignore bigger ones that are kind of more out there that's more likely. So if we're thinking about making investments, making certain you sharpen that pencil and you're like assessing the risk appropriately, not too focused on recency bias on something that you just went through, and not ignoring kind of the bigger, longer term risks, and too worried about the really small things that if they happen, they're, you know, really bad. But if the probability is very near zero, that's not something, you know, where you're going to make big investments on generally.
Sam, you talked about in your last response looking at milk price projections, and you know, we've seen a $3 swing in the Class 3 futures for 2021, the bundle of them by month already this year. With that said, how are you approaching milk prices, or what price are you looking at using in a projection for 2021?
Yeah, that's a great question, because it's just looking at 2020. The first month where we had a huge PPD, I can't remember if it was June or July. I surveyed our bankers, and they said, what were the pay prices that our clients received, you know, from their dairies? There was over a $6 a hundredweight difference. That's incredible. So it's not just about what the base price is, but also what's your basis? What kind of, you know, either positive or negative basis do you have on that price? So Roger mentioned it earlier. This is an individual farm situation. So we're not using the same price for everybody, but it depends on where you're shipping, what that historical level of basis is. And you start at the baseline with the best data you have available. And right now, that's what the futures market looks like. And in our predominant market in the upper Midwest in Wisconsin, it's a Class 3 market. So you're looking at what that Class 3 price is plus basis, and that's your starting point. And from there, you have to perform sensitivity analysis. And where is cost of production? Where is break even? We talked about the volatility in milk prices, but we haven't talked. You mentioned it with one of your poll questions about feed prices. That's huge. Corn is up 15%. Soybeans up over 25% compared to where they were a year ago. That's going to have an outsized impact on feed expense this next year. The only good news is, and I didn't really mention it before, but at least in our core market, 2020's harvest, the feed pile was bigger and it's a better quality. And that's really helping people. That's giving them a little bit of, they don't have to purchase as much supplemental protein or energy, and productivity is up on a per cow basis. So efficiency is improved. But part of that key is the cost of production that you calculated even 6 months ago is no longer accurate. You got to recalculate it now, and you got to look at what it is on a go-forward basis. So put that base price in, Corey, and then do sensitivity analysis. Where is your cost of production? Where is break even for you? And utilize that in helping to outline what your price risk management plans are going to be.
Thank you, Sam. We got well over a dozen questions that have rolled in here hot and heavy. So we're going to probably go a little bit more singular in response now. But this is still in the same vein, Roger. The question is, how do you best monitor a customer's risk or exposure in the marketplace, talking about price protection and hedging? That's the first part. And then I'm going to kick the second part over to Chris, and he can get thinking about that. Do you have a recommended training for customers and staff in this area, Chris? So the first part is to you, Roger.
Well, we typically monitor folks by a monthly reporting with some of our business consultants that they're on, a profit analyzer it's called, and in that they would review what they've done year to date and what they're doing for projections. A lot of our customers have that similar kind of discussion and relationship with their loan officer as well. But I would tell you that we're really more monitoring the usage on their operating lines of credit and what they have available for flexible needs down the future. Really, we try not to overstep our bounds when it comes to managing and understanding what the management is doing with their price protection, but we do want to understand what their overall goals are and what their plan is for the year. And that's really how we start with that.
So Chris, we're going to send that second part there to you, and another question just came in. So what are some tools that to get yourself up to speed a little bit more in this area of price mitigation and that? And this is on the buy side and the the cost and expense side. And then another Dairy Livestream viewer says, we just need more professionals to understand milk markets. The dynamics are so complex, and this isn't easy, but we can all help ourselves too. Chris?
Yeah, no, we did a survey a few years ago nationally of dairy farmers, and the single biggest impediment to using dairy risk management was understanding, and the second biggest impediment was management time, right? Because dairy farmers, like all of us, tend to bite off about as much as they can chew or more, and depending on whether you're part of a management team where somebody can dedicate more time to understanding and following these markets kind of affects how much you can use it. I think there are, hopefully, the state you're at, the Cooperative Extension Service, has educational opportunities for you to look at. You can go to dairymarkets.org, which Mark Stevenson runs, does an excellent job, and there's some good resources on there for understanding these tools. I personally have worked with a lot of different, with the farm credits and with banks in some situations to put on educational programs. And so hopefully there's some of that out there to, get you going. And like you mentioned, there's a whole lot of new tools that we didn't used to have, right? It wasn't that long ago when this was a lot more difficult because you maybe had to go to a broker yourself, which you still can, by the way, or go through your co-op. But now there are, true crop insurance type programs with premium subsidies available that you can also tailor to your own situation. Sam was talking about, obviously, in the upper Midwest, it's class 3, and that's going to do a pretty good job. And for a lot of those guys, maybe helping them with their basis risk, which is a big deal. But you get up here in the Northeast and you have a different kind of, a portfolio of class 1, 2, 3, and 4. And now that we can use class 4 and we can do butter, fat, and protein and things, mix it up like that, we can, it's more complicated. There's maybe a bigger learning curve, but you can do a better job, hopefully, of tailoring it to your situation.
So the next question we're going to give to both Sam and Roger, and we're going to start with Sam here. And this comes in from a person who was once in the baking industry, and it's a darn good question because in some ways these days, you're only as good as the people you surround yourself with, your advisors, your employees, and all that. So the question reads like this: if you have a good lender that you have been working with, how much of a percent difference is it worth to keep working with him or her rather than switching to another lender with a lower rate? Is it worth a quarter point, a half point, 3/4 point, or a full point? Now, you may not want to put a number on it, but I remember my late father saying, it's not worth me chasing that half point because I got a good team. Sam, I'm going to kick that one to you first.
Thanks, Corey. I appreciate you kicking that to me. So the answer depends if they're working for me or not. Okay, so they're worth more if they do, and I really feel that about my team. They're fantastic, and they're great to work with. I can't put a number on it, and believe me, clients do, our customers do, and our prospects do. They certainly do put a number on that, and it's different for everybody. But the time that you're tested on that is not when things are good, it's when they're not. And that's where the value of longevity and understanding the nature of cycles and knowing what the management ability of that particular client and what they can and can't do. So it's very important. Rate is very seldom the reason that you should bank with a financial institution. There are far more things that go along with it, and it again has a lot to do with the tenure, expertise, and additional tools and things that they can bring to the operation. Money is a commodity, but knowledge is not, and understanding of what and how you operate during the cycles. It makes a difference. Absolutely makes a difference. Roger, I'll flip it to you.
Thanks, Sam. I agree with your statements. Certainly, you can't put a number on it, but any of the surveys we've done, interest rate is typically number 4 or 5 on a list of top things people are looking at from their lender. And obviously, you got to be competitive, and it like your feed bill, like your equipment purchases, like anything else, you need to be testing the market. But we really try, and I think it's important to be competitive, but after that part, it's looking for the total relationship. What value are you getting from your lender? Are there other auxiliary services? Could it be cash managers? Could it be tax and records and financial services like we do? There's a whole bunch of different options that can put this together. I think it's also really important as a business is in a management succession transition plan that lenders understands not only the previous generation but the next generation that's taking over, and building those relationships with those future key decision makers and supporting them. I think Sam's company and ours and others, of course, support the industry. So it's not just what are they doing locally, but what are they doing to help the industry as a whole by partnering with local universities and extension to do some additional training and leadership and management development as well.
You know, a number of years ago, I put up a substantial building and got 5 bids from different builders, and the one that I wanted to select came in the highest. And I remember my younger days hearing Phil Plord say, you know, you're better off asking a question and making a statement. And I took that approach and went back to that builder and looked at his bid, and I said, I must be missing something here, because I can't possibly think how you're 20% higher. They went and reworked their numbers. I never told them what the other ones were. And they came almost right in that small little window of the rest of them. And I landed up picking them. And over the years, that relationship had grown. And I know that had I not done that, it probably would have been a bad decision for me long term. So sometimes you do got to go do your due diligence and then ask the question. You know, in March, April, and May, and then it kind of went away, there a lot of base excess plans went into place. And a lot of them slid, but now we're looking at 100,000 more cows on there. And so the question, we'll start with Roger. How do you evaluate individual producers if we go into a base excess plan again? What the plans differ quite a bit from handler to handler. What are you looking at? What's your advice? And actually, I'm going to start with Chris, because in dress rehearsal, we were talking about that. It just popped into me here. And so Chris, go ahead and talk about that. But we got that question in 2 or 3 times here today on Dairy Livestream. Chris?
Yeah, no, I think it's a really, really good set of questions there. You know, we're in a situation now where we made a lot of butter. We made a lot of other products, but we made a lot of butter to balance markets in 2020, right? And we're sitting here with butter stocks that are pretty darn high compared to historic rates. Now, the good news is we've had pretty strong export markets, and we're pretty competitively priced on some of these, so we don't necessarily have to eat it all. We can export some of it, and that's good. But you know, that combined with the potentially you know, $5.40 corn, $13 beans, you know, we could be looking. Actually, the high feed prices, if it continues, would put a damper on milk production, but we've got high milk production. So I'm hearing from several different co-ops that these base programs that have been on the books, right? They didn't go off the books, but in some situations that penalty for overbase went essentially away. And so there were some farms back in last spring, in May, June, that maybe cut back a lot because a base program was put in. Some of them were happy maybe with those decisions. Some of them were not so happy because if the overbase penalty went away, then maybe they wish they'd kind of left things alone and continued on. because as Roger mentioned, right, each lactation is an investment, and you have long-term implications when you make these. But right now, I'm hearing from a few different people that I've talked to, particularly in this part of the country, that some co-ops are putting in some pretty significant overbase, if you'll allow me to call it that, penalties. And so the decisions that the farmers are going to have to make are going to be, it really depends on how long do you think this is going to last, right? When if this is going to be a 3-month or a 2-month problem, or it's not as the same decision as if it's a 6-month or 12-month problem. So yeah, I think that these are going to be really important issues to a lot of different farms as we go forward. And I'd like to kick it to Roger and Sam and hear how they're approaching it.
Sam or Roger, go ahead.
All right, I'll jump in. That's probably the number one question we get overall is what should I do? Should I buy base or not? What is a base worth, even if I could find one? And obviously here in the Northeast, that wasn't as common of an issue for a number of years. And now up until recently, it had become a hot question. And it really depends on that individual farmer and their ability to make adjustments, which is the least cost adjustment they could make. Typically, the number one thing is to improve their milk quality. There's a lot of folks out there that can make another 30 to 50 cents a hundredweight just by improving their quality and being consistent with it. That doesn't count against your base. That's just increasing the quality. The other part is adjusting their feed ration. Maybe as Chris talked, the components may not be worth quite as much as they used to be. And maybe so feeding extra costs into that ration to bump up components may not be as profitable as it was, say, 1, 2, 3 years ago. And so there's some differences. One of the things that we look at or get asked as well, I have an overcrowding situation in my herd. What if I, how much could I improve profitability by lowering that overcrowding? And most of the time, obviously that could help as well. So I won't get into specifics, but those are 3 things that we've seen. I'll turn it over to Sam to let him add on.
So I think, that we hadn't seen in our core Wisconsin market a lot of the base plans until the last couple of years, and in particular 2020. And so we haven't had the same kind of discussion and comments that Chris and Roger talked about experiencing in the Northeast, but it certainly is an issue. And Corey, your poll question earlier, 100,000 more dairy cows across the country. Why did that happen? Well, it happened because the market sent the signal, hey, prices are high, add cows. And so with our clients that are in that situation, if they wanted to add cows, in particular, if it was, I'm putting up another barn and gonna populate it with more animals, our number one question is, do you have a home for that milk? And that means just not a verbal from the field man. Do you have an agreement with that processor? Is there a slot for that milk? Because if you've got markets where there's a base program and an excess, and we all saw the stories on the nightly news and Wall Street Journal and New York Times of milk dumping from last spring, nobody wants to do that. You put too much money and investment into that. So have a home for it. And that's just sound advice. Everybody should have a good arrangement with their processor, whether it's a co-op or a private, to make sure that they've got a slot and a home. Because if you don't, then you don't have a market and you got financial problems.
Big time. We're going to go real specific into a couple of groups of farms here, but they're really good questions. This one is going to be anyone play on the answer. Have any panelists looked at the true cost of homegrown feeds as it relates to profit? In Pennsylvania, people from Penn State Extension see a high correlation, this person points out. Some farms can raise a ton of corn silage for $20 per ton, and another farm it costs them $40. But has anyone looked at the cost of homegrown feeds?
Chris, have you done any work with that area?
A little bit, but I don't know if it's exactly along the lines of what they were talking about, but we did some very detailed enterprise accounting studies where we looked at each, we looked at the dairy herd, the heifer enterprise, the corn enterprise, and so on and so forth. And what we consistently found was that the forages paid for themselves all the time, and the concentrates many years did not. And so obviously part of the way dairy farms self-insure is by growing their own feed, and it makes more sense to grow forages because you don't want to haul water around, and corn silage is 2/3 water, right? But in that case, and so I don't know if it exactly addresses that question, but definitely the forages were paying for themselves. And in the years when we used to have a lot of years when corn was below cost of production. We haven't had that as much since we kind of entered the ethanol era, and we may not have that this year either. But on the other hand, $5.40 corn, the cure for high corn prices, just like milk, is high corn prices. So my guess is we're going to find a lot of corn acres and soybean acres coming up. But yeah.
Yeah, I would say, I'm sorry, just going to tag on. Haven't studied that, but any number of dairy consultants that work with our clients do that analysis, and it bears out what Chris was saying, and a lot of it has to do, of course, with transportation costs. So it's certainly a bias that I take into looking at an operation. When you've got high commodity prices, high feed prices, you're better off with homegrown feeds than you are with purchased feeds. And when that situation is the opposite, then it can be more beneficial to buy everything instead of grow it. So having some kind of risk management with some grown, some purchased, that tends to be the wisest plan on a long-term basis.
And every farm is different. So my dad had an extensive line of machinery. I'm asking myself how many hours, and I'm managing the farm now. How many hours am I putting on that 150 horsepower tractor? How many hours am I putting on that windrower? And the final decision, and it pained me so, they're going in an auction on April 8th because they're not performing enough ROI for me. And I turned around and went to some dairy farm neighbors who have a nice line of equipment. One of them is going to cut my hay for me. And with the machine they got with the bat wings and everything, they can hammer it down twice as fast as I can. And the same on that tractor part. So, part of that is the answer, where do you deploy your assets the best? And when it came down to that tractor sale in November, the 100+ horsepower category was up 24% for the Association of Equipment Manufacturers. So hopefully I'll be selling when it's high, but you make the best decision at a time. Hey, something might happen between now and April, and that all goes kapow for me, but that's the decision we're going to make. Another group of farms, are there any particular risks you evaluate for organic dairy farmers? And I have a Amish neighbor friend who milks 100 cows, and he wanted to actually go conventional. He was kind of, wanted to go back to the way he was, and his banker said, let's run the numbers because I don't think that's going to work for you. But there are bankers that are doing that. And do you look at your organic herds a little differently, or is it pretty much the same principles? Roger or Sam?
Yeah, we look at them a little bit uniquely in that one, the herd management skills have to be that much stronger on an organic dairy than the conventional. Not to saying that conventional don't have good husbandry practices, they do, but they have more tools at their as a resource to be able to manage those things. So we look at their overall ability to manage, and then also their cropping program, because organic tends to be a lot more forage based and grass fed. Their ability to have access to consistent resources that way makes a big difference as well. So to me, it's more about the management and location than anything else.
Just to add, there's less volatility in organic because the price tends to hold, and it doesn't have the same fluctuations that that non-organic milk has. However, it's been pressured down as more organic production has come on. the premiums that you got for organic milk have come off from what they had. But Roger hit on the key, and it's the feedstuffs. I mean, the real key on the organic side of thing is where are you going to source your feedstuffs? And again, a lot of it tends to be local and forage based.
Chris, anything to add on that one?
No, I mean, I think they hit the good points. One thing that I'm struck with when I look at organic dairy farm financials is the potential fluctuation in the feed costs, right? Because you can't just call up the local elevator. So you've got to have a buffer built in there. And if you have some, bad weather, you have a drought or something, it's a potentially really big deal, because you can't just go down the road and get the feed you need.
And this, Sam and Roger alluded to, the price is a little bit more stable in the organic area, but the downward pressure is true. And in the dairy market news published by AMS, USDA's AMS division, they had a tidbit in here that I read this past weekend. 2020 farm gate pay prices were about $31.55 per hundredweight in 2020. The range was as low as $27.13 and a high of $31.42. But by historical comparison, the 2009 average pay price was $27.13 and $31.70 in 2012. So there hasn't been upward movement on that category in terms of take-home pay. So if you're an organic producer, they're facing the same things with higher input costs. So it's not a panacea as well. We got a few minutes left here. We're going to go to a real speed round here. Roger, this one to you. Have you changed your owner equity or loan to value minimums here during the pandemic, or are they pretty much the same?
They've pretty much stayed the same. We look at cash flow as the number one thing we look at versus balance sheet and collateral. Certainly more of a cash flow lender, and our overall debt to earnings before depreciation, interest, and taxes, debt to EBITDA, is something that we monitor.
Chris, this one's to you. Do you see an impact from margin calls or hedging losses last year from the farms that you've worked with and the conversations you've had?
I've heard some about it. I haven't seen it show up big on any financials, but the other thing I would say about the early financials when we do this is sometimes the early ones that come in are the bias towards the better years. The guys that do it first. So, but that's a good point. I have heard some anecdotal stories about margin calls.
Sam, you guys, we're into 2021. What are the early projection cash flows looking like? And maybe we don't need numbers here, but maybe in comparison to previous years.
Yeah, they're certainly lower than what we saw in 2020. It's more akin to 2019 is what we're seeing on the early side of things.
And I'm not sure any of our panelists will have anything here, but this is a question I just want to get our viewers thinking about here. We're into a new administration here, and the Biden administration, incoming Secretary Vilsack, and the Senate Ag Committee have all talked about climate initiatives and potentially voluntary systems that dairy farmers, or excuse me, all farmers might be able to participate in to sequester carbon. Any early thoughts on that, Sam?
Yeah, let me weigh in first. So a couple things. I think, and I've sat in on a few webinars about carbon sequestration, and I think there's going to be some really opportunities for farmers, particularly on the dairy side. You think about an alfalfa crop that's a multi-year crop that's got ground cover. You may be able to glean some benefits, and I would expect that you're likely going to see some things come through USDA or congressional action on that front. The other thing we're hearing a lot of, and we're getting a lot of traffic with our dairy farm clients, is on renewable natural gas projects, and seeing some things come on down the road on that. And there's some pretty promising economics there. The question mark is, what's that investment? How does that get funded? How much capital does it take? Who's making it? Who are your partners? There's a whole host of things there. But I think there are some additional potential revenue sources that can aid the ag sector to be a solution on the climate side.
Roger, anything to add there as we come to
Yeah,
a close?
real quick, I would say most all of our dairy farmers and farmers in general have been great stewards of their resources, and to be rewarded for it through some administrative program that the federal government's putting on can make a lot of sense and allow them to continue on for more years. I will say the renewable gas methane digesters is something we've been working on quite a bit here in the Northeast and over the years. And some states have required food waste to be also not going to landfills, and that can be added to methane digesters with tipping fees. So it's really been an interesting business model. There's been some outside capital being poured into this as well. And I think there's an opportunity for certain farms if they're located correctly. But it's not for the meek. It does take a lot of management time. That isn't a part-time job. It's a full-time job for those kind of things, and obviously professionally done. So can be a real advantage, and I think here in the Northeast, we'll have an opportunity to take it on more of those projects.
Well, thank you. Our next dairy live stream will focus on Let's Unpack block and barrel cheese pricing. The show will air on March 3rd, 2021 at 11 p.m. Central Standard Time. It will be archived on the Hordes Dairyman YouTube channel the very next day, just like this program. We look forward to seeing you then. On behalf of Sam Miller, Roger Murray, and Chris Wolf, I'm Corey Geiger, your host. Thank you for joining us today. We wish you all a good day. Goodbye, everyone.
Goodbye. Thanks.